Welcome to another episode of the Capital Spotlight Podcast. I'm your host, Rob Beardsley. Today I have Joe Kunzon with me from New York Mortgage Trust. Welcome.
Thank you.
Good deal. So give the listeners a little bit of background about yourself as well as New York Mortgage Trust.
So my background is I've been in lending for 30 years, started with Merrill Lynch and worked for a small group that did business lending. And how I got into real estate is in the late 90s. Merrill Lynch was one of the creators of the CMBS, as we all know now, commercial mortgage securities. And I started selling, loans into, CMBS pools, something that was cutting edge at the time, was different. People didn't understand it, but it got me kind of the real estate bug, and I slowly transitioned my way into doing more real estate than I did commercial lending. After that, I started working for a small Chicago area bank, and we did, ground up construction loans and also stabilized loans. From there, I worked with Bridger Commercial Funding, and Bridger was a CMBS lender, mainly doing small balance CMBS loans. And after the recession of 2008, I moved over to New York Mortgage Trust / Riverbank when we were two companies doing mezz and preferred equity, behind multifamily, and haven't looked back since. So I've been doing that for the past 10 years.
That's great. Yeah, so today is all about preferred equity. Looking forward to diving in, talking about the way that you guys approach the strategy, how you structure the deals, what you're looking for in terms of a deal and a sponsor and a business plan. So, let's start out with, just for those that aren't familiar, in your words, define preferred equity and the objective of your program.
Sure. So preferred equity and mezzanine are used interchangeably. Really, to me, they're the same thing. The difference is, the legal avenue to get the dollars to the asset. So in a mezz loan, you are creating a note and security agreement and taking the partnership interest as collateral. In a preferred equity, you are part of the operating agreement, so you're inside the entity that ultimately owns the asset. And most of the lenders after 2008 preferred equity, no pun intended, mainly because of the mezzanine lenders were able to hold up a foreclosure versus preferred equity. You either had to make the choice of to pay off the senior lender, or they looked at you more like an owner. So, and you couldn't foreclose on yourself. So it's an easier avenue for a senior lender to foreclose on a property if they had to. So pretty much all the lenders, mainly Freddie and Fannie, who we come behind in probably 80-90% of our loans, all require preferred equity, and they sometimes say they do mezzanine, but they truly don't.
Yeah, and you bring up a couple interesting points that I wanted to cover today. One is, do you differentiate your pricing based on whether you're coming into the deal in a mezzanine structure or a preferred equity structure?
No, the economics are exactly the same.
Okay, so one's legal structure and collateral, if you will, doesn't really influence the way that you look at the deal or how much downside protection you have.
No, I mean, if for whatever reason a lender or a borrower, for that matter, said we really need to do this as mezzanine, there could be maybe a tax implication. We'd certainly do it, and it would be no different. And you just, again, the wording and the documentation is a bit different, but from the economics, it's exactly the same.
Got it. And the other thing, which is interesting, you mentioned that the vast majority of your pref and mezz positions are behind agency, and from my understanding, agency is pretty tricky to navigate in the pref world, and they don't really allow hard pref, and you have to place your money as soft pref. But I wanted to get your take on that and how you structure that.
Sure. So, if you take Freddie and Fannie, and let's say they're each 50% of the business out there, a majority of our investments have come behind Freddie. And the reason for that is they're a bit more transparent as far as what they want, as far as their pref equity agreements are concerned versus Fannie. A lot of it has to do with just the ultimate way that they are funded. Freddie essentially does a CMBS style securitization. Fannie is, for lack of a better term, probably a reinsurance company where they sell off whole notes of what they funded and they back them 100%. So because of that, Freddie is, they know, you can ask them, they know exactly what they want, and we know what they want. With Fannie, sometimes I can get different answers from different DUS lenders because the way they underwrite is they delegate a lot of their underwriting to the various DUS lenders like JLL or Walker Dunlop or CBRE, and they may have all different answers as far as what we can and cannot do. So that being said, it tends to get pushed over to Freddie a bit, and Freddie will allow hard pay pref equity. They have certain limitations on that. For instance, you can only invest up to a 105 debt service coverage, and that debt service coverage is defined by their underwritten NOI divided by the principal and interest on the senior, regardless of the IO, and the pref equity hard pay. And the hard pay is defined by what is the economic default on the pref equity. So, most of the time, our hard pay will be, let's call it a 5. They'll use that 5 number in that debt service coverage requirement. And again, is the hard pay is simply, if you pay the 5% hard pay, there is no economic default. If you can't pay it and then some, there is no default. So it's pretty clearly defined.
Yeah, let's take a step back, and I kind of jumped into the hard versus soft conversation. Can you just go quickly between the two and the advantages for both sides for each?
Sure. So hard payment, usually the agencies will only allow a pretty simple and straightforward economic default event, and that'd be a payment default. Before there was groups that were putting in defaults for things like occupancy requirements or debt yield requirements, and pretty much they eliminated that and saying, they either pay a minimum dividend, on your pref, or they default. So it's just a straight line payment default. Soft pay is there is no economic default. So usually what happens in a soft pay deal is, the property can only be taken over by the pref equity provider only in cases of bad acts. So if the property tanks and let's say the occupancy goes to 70% or the debt service coverage is less than 1, you cannot, as a pref equity provider, step in and declare a default. What you can do, and most lenders do when they only have a soft pay pref, is have a buy-sell arrangement, or we call it a drag to market clause, where we can raise our hand and say we want out, and we give the owner 30 days to decide how they want to get us out. They can sell the asset, they can cut us a check, they can find another capital provider, and then 60 days, 90 days to execute on that. Usually in those scenarios, it will be selling of the asset to get us out. So it does force the sale if for whatever reason we deem the asset to be declining or somewhat, not what we anticipated it to be.
Yeah, I noticed that clause in your term sheet, the drag to market, and it says the right to drag to market after 2 years. So is that 2 years and there's some sort of bad act or underperformance, or is it just 2 years unilaterally you can force a sale?
No, so if there's a bad act, the bad act will allow us to take over the asset. That's the only way we can in a soft pay pref agreement. As far as an economic situation, we have a 2-year lockout, meaning we can't enact our buy sell for the first 2 years. Otherwise there's a risk to the borrower saying in 6 months that we could say we want out. They wouldn't be able to get us out, and they'd have to sell the asset, and they'd probably take a loss because they've only owned it for 6 months. So for that, we give them 2 years. We take a little bit of a prepayment for those 2 years. So in a worst case scenario, if we funded the deal and the property tanks and they're not able to pay us anything, with a prepayment, at least we have some sort of payment for those first 2 years until we can force the sale of the asset.
Got it. And so how do you manage maturities, right? So there's also, it sounds like Fannie may be more concerned than Freddie, but maturities are another thing that are, put the pref more into a debt-like vehicle than an equity-like vehicle. So what is your stance on maturities, and how do you structure those?
Yeah, so typically we have our pref coterminous with the senior. So if it's a 12-year deal, we'll do a 12 years. If it's 10-year, we'll do a 10 years. The agencies typically want you to either be outside of the maturity. So usually for us, it's coterminous plus 1 day, or Freddie will allow you to mature it as long as it's 2 years or earlier before maturity. So what they don't want is to get locked up at maturity for like a maturity default with the pref equity lender if say a refinance or a sale's delayed and you're coming up against those deadlines. We always do it coterminous, mainly because, especially on a fixed rate, it would put a borrower in a bind if, let's say we matured it 2 years before the senior and we had maturity and they'd have to pay us off and they'd have to sell. They'd probably have to pay some sort of large prepayment penalty with the senior lender.
Right, absolutely. So, and then you mentioned maturity default. So what are your remedies that you have at your disposal for a maturity default?
Well, a maturity default would just be like any other default. We would come in and step in to be the GP of the entity that owns the asset. And if we think that there's an asset to be saved or an investment to be saved from that asset, we'll end up probably trying to sell it ourselves, or if there's a problem with the asset, we'll refinance it and we'll fix it up in order to get our investment out. But realistically, we don't want to own the asset. We want to get out as soon as possible, and if that means we have to put in some additional monies to fix up, let's say, some deferred maintenance, we'll go ahead and do it. But also on the flip side, if it's not worth saving, if we don't think we can recoup our investment, we would probably just let it, default to the senior lender and step away.
So something unique about you guys is your willingness to go on a longer term basis on your pref.
Mm-hmm.
Vast majority of pref lenders I speak with, they're looking at 18 to 36 month terms. They want to churn their money. They want to be sitting behind a bridge where there's a clear value add strategy to allow for the pref to be taken out either through a sale or a refinance.
Right.
So the question for you, as far as a longer term where your accrued payment is just growing your basis in the deal, essentially, how do you guys underwrite and get comfortable with that fact where, there may be, 40 points of accrual building up on over a 10-year hold that needs to, get paid to you in order to earn your return?
Right. So we do it. The reason why we go coterminous more than anything is we're a publicly traded mortgage REIT and we have a balance sheet. So theoretically, anything we get redeemed back to us, we got to go out and redeploy. We're not a fund investor, so we don't have to refund any investors. If they want to get their money out of our company, they sell the stock. So that's one of the main reasons we do it. But as far as, the accrual and how can we do it for 10 years, it really depends on the structure of the senior. So if, for instance, someone comes to us with a fully amortizing senior loan and we have some sort of pay and accrue feature on our pref equity, we can hold that pay and accrue, for possibly the entire length of the time, just because we're burning off debt in front of us. Conversely, if someone comes to us with let's say an all IO deal or a 5-year IO deal, which is fairly common, we can offer some pay and accrue, but eventually we're going to ratchet up our cash payment to minimize the accrual, because you're right. You can have, if you accrue for 10 years, a $5 million investment become a $10 million investment at the end of 10 years. So we want to minimize that. Now, usually what happens though is, during that first 5 years, there's some value add program or what have you, and the borrower will take us out, let's say with a supplemental, or they'll sell the asset before even the AM hits. So I'd say, a good portion, more than half of our redemptions have occurred mainly because of refinances or sales well before the maturity of the investment.
You mentioned something earlier that it was one of my later questions, but I'll ask it now, which is, how does being a publicly traded company affect, I mean, I think I got one answer there in terms of being comfortable in a longer term, but what are the other benefits and drawbacks of being a publicly traded company?
Well, one of the advantages is our access to capital when things are good is easy to get. We can literally pick up the phone, sell, a couple million shares of stock, and within a few days we have capital to work with. That worked well up until about February. March hit, the markets, went south. The bond market was basically frozen for 2 weeks. So it caused a lot of stress in the mortgage REIT market because of the way we finance our, with our counterparties. So that was a big disadvantage because, mark-to-market accounting, happens within hours, versus if you're investing on behalf of investors with the fund, it takes a while for them to say, well, it's not worth as much, or I want my money back. When you're working with a REIT, with a balance sheet, with a bunch of, repo lines and other counterparty trades, sometimes within hours, things change. And that's what was happening at the end of March. So, that would say the biggest disadvantage, but, raising funds when times are good, and also the fact of having a balance sheet and able to go out long-term, I think is a huge advantage. And it works well for our platform, and our investors like it because they don't feel they're under any pressure to sell, to sell early if they don't have to, or sell into a market they don't want to, or incur a rather large prepayment penalty on the senior.
Right. So yeah, you mentioned some of the financing that happens at the corporate level. What is your capital? How is your capital structured, and is it levered? What kind of returns are you solving for internally on this product?
Well, we're a unique mortgage REIT. Some people call us a hybrid, because most mortgage REITs invest in, agency-backed paper on the residential side, or any sort of residential paper. We do too. We have half of our balance sheet that I have nothing to do with, that invests in whole note mortgages. We used to have some, mortgage bonds, on the residential side, some agency backed, some non-agency backed. And then our other half is investment in the multifamily space. We did invest at one time into a pool of Freddie Mac B pieces that we sold off, back in March when everything was happening. So, from that standpoint, we're a very different mortgage REIT than a lot of them tend to just focus on, on mainly just investments into residential backed securities. Now there's a bunch of equity REITs that are owners of properties, but they really own and manage properties. We don't manage properties. We invest in them, but we partner up with operators, and they operate the property as they see fit. So in that sense, we're very unique as far as, the rest of the mortgage REIT sector. I don't think there's a true comparable to us as far as what we do. And I think that's going to change a bit, also going forward, just for the fact of, what we went through and some of the things we had to do moving forward. You change our philosophy slightly. When the once in a lifetime financial event happens twice in 12 years, causes you to think about what are we maybe doing wrong that we can prevent this from happening again.
Interesting. So I want to jump back to the hard versus soft discussion and just go through those programs a bit more. So the other term I saw was 90% max LTV, and doesn't seem to factor in CapEx costs. I may be wrong about that, but I was wondering how you incorporate the sponsor's CapEx plan into your evaluation.
Well, if someone comes in and buys a $50 million asset, and let's say they want to put $3 million of CapEx into it to improve the property, we'll look at it as the cost of it being $53 million. So long as that CapEx is reserved or somehow we're able to disperse it. And if the plan checks out, and if they invest $5,000 a door and they can get $150 pop on rents, and it makes sense, theoretically we can get up to 90% of that $53 million in this example. Typically though, it's hard to hit that 90%. It's maybe a little bit easier today, is just because you normally get constrained by debt service coverage ratios and what specifically Freddie Mac imposes on you. On the soft pay, they don't impose it on you because they don't care, because there's no economic default. But usually we get some sort of stress from the cash flow, so we're not able to do the full 90%. But it's been creeping up a bit lately, just because now borrowers are able to get 10-year fixed rate financing at around 3%. In pre-pandemic, it was hovering around 4.25. So that's a pretty big drop. You can fit a lot more debt into the same asset, producing the same amount of cash flow.
Yeah, absolutely. So we've mentioned some few situations where economic default, maturity default. Can you talk about a situation where you guys have had to step in and take over management?
We really haven't had too many. We haven't had an economic default yet. We've had a few defaults by bad acts, where the borrowers were, doing things they weren't supposed to, and we give them notice and they weren't able to cure those defaults. So we had to step in and control the asset. And, really the minute we stepped in, we assessed our investment, assessed the property, which we had a pretty good handle on, and really just went in and sold the assets to recoup our investment. So it was, fairly quick, as far as what we wanted to do, what we wanted to do, how we wanted to do it. And, anything we collected above our investment still went back to the sponsorship. So even in an adversarial type of relationship.
That's actually very interesting. And so what are the economic ramifications of stepping in? Do you dilute the common equity? Is there some sort of default rate that you're now charging?
Yeah, there is a default rate. It's 7% or 700 basis points above what our initial rate was. And then all the fees that we incur to take control of the asset and ultimately sell it. So is it meant to be punitive? Yeah, it is. We don't want borrowers to commit bad acts. And the bad acts are very similar, to what the same bad acts clause the agencies or any other senior lender have, whether it be fraud or misappropriation of funds or committing a felony, or there's many of them. Common sense, as I say. So really it's a lot of our default interest rate. It's because the minute we take over as GP, we're running the asset, and we're not set up to run assets. We're set up to manage investments, not run multifamily properties. So our theory is, if we're going to step in and control it, we want to get paid like an owner. And it's, again, also to be punitive. But eventually what we do is we just want to exit. We want to get it off our books, recoup our investment, plus our return, and get out.
Right. So I noticed on the bridge preferred product, there's a pretty large exit fee of 2% incorporated on the total debt stack, right? And that sounds pretty expensive, but with the caveat that it's waived if the refi is through you guys. So is that a pretty good incentive? Do you end up getting a lot of refinances through New York Mortgage Trust?
Yeah, the whole intent of that bridge program is to get an unstabilized asset, whether it be because of lease up or because of some sort of event, to a point where it's stabilized. And the secondary intent of it is, to capture that refinance market. So yeah, understanding that who we've partnered up with to do the senior financing, it's to capture that permanent financing at the end, really. And if they choose not to use it, yes, that's what compensates us for not getting that end result. So, understanding that it's probably a good product for a lot of banks, that are sitting on a bunch of construction deals that, maybe have taken longer to lease up because of the pandemic, and they either need a pay down or they want it off their books. This is a good product for that. Typically we haven't been a short-term bridge equity provider. We always had some sort of large, I would say, return multiple, to be in the deal at least 3 years. This deal, they only have to be in for 6 months, and so long as they refinance with us, there's no other exit fees associated with it.
That makes sense. And do you act like a broker in that refi scenario, or do you have a specific lender go to on the agency side for the stabilized takeout?
Yeah, we have a partnership lender that we work with that we can't name, that works with us, and this is a venture between the two of us. So they want that business, and we felt in order to do the bridge equity, it's something very counter to what we've been doing in the past, but we thought this was a good opportunity to get something in there quick, and once it's stabilized, to flip it over into an agency or long-term financing solution upon stabilization.
Got it. Makes sense. So can you explain the operator partner program and what that is?
Yeah, it's just a list of operators that we have that work with us either on the pref side or that maybe want to work with us, that getting back to issues of defaults. We're set up as an investment firm. We're not a fully integrated shop where we have an asset. We have a property management firm, we have an ownership firm, and we really want to act like a mortgage REIT. So because of that, when we take over these properties in a default situation, we're not running them. So typically, who would we use to bring in to manage the asset until we decide what to do with it or until we dispose of it? It's probably someone we already work with, that we trust, that has done a good job. So we bring them as a manager and possibly a buyer to buy the asset. We've done that on a couple occasions where we've had in the scenarios that I told you about. We had someone come in that we knew, that was familiar with the market, to manage the asset while we decided what to do. They did a great job. They ended up being a partner and buying that asset from us at the end of the day.
Very interesting. I like that. So lastly, I wanted to dive into the CMBS side of the business. You have a background in CMBS, and you also mentioned some of the Freddie Mac B pieces that you were involved with. So just tell us more about that side of the business.
Well, the genesis of our company that started back in 2010 was buying the very first Freddie Mac B piece, 10-year fixed rate note variety. It was a great investment because at the time there was no liquidity in the market. We're just coming out of a big recession, and I think the modeled return on it was in the 20s. Just to give you an idea, the modeled return on these things now are probably in the 8s. So it was a great investment. Our ownership at the time had a prior relationship with Freddie Mac, so it turned into a business for us where New York Mortgage Trust was actually providing the capital for us to buy these B pieces. And New York Mortgage Trust took us over about 4 years ago. We continued to do that business, for almost 10 years, and it became a big part of our program. As I mentioned before, in March we sold our portfolio, our entire portfolio, for a variety of reasons. It's not like we were disappointed in them; they were great investments. But if you understand the B pieces, they're essentially zero coupon bonds, and inherently they're a little bit difficult for a mortgage REIT to keep on its books because we have to pay a dividend. They're not paying any income. So we really rely on liquid capital debt markets. And in March and April and May, there wasn't liquid debt markets involved. So we had to make a choice to sell those assets. But they were essentially very similar to, if you want to call it, in the same scope of direct preferred equity and mezz investments, just a bit different dynamic. You're not going up the capital stack as high on every deal, but you incur the first losses in the entire portfolio until your investment is exhausted. So a little bit different type of risk, but they were great investments. Freddie Mac does a great job. We have a good relationship with them. And then maybe some point we may get back into that into the future, but as of right now, I don't think we are at the moment.
Right. It seems like a bit of a maturity or liquidity mismatch there for the B piece and the publicly traded entity.
Yeah, they're better situated for funds, especially for funds that are not looking to pay out a quarterly or somewhat regular cash payment to their investors. If you can hold them to maturity and don't have to worry about cash distributions, like I said, they're a great investment. Our ability to hold them was based upon a lot of these bank repo lines that were in flux back in March. So that pretty much kind of made the decision for us.
Well, Joe, I greatly appreciate your time, and it was wonderful hearing your insights. Go ahead and let listeners know the best way to reach out to you and to work with New York Mortgage Trust.
Sure. It's my direct number is 224-848-4028, or just a simple email at jkunzon@nymtrust.com. And certainly happy to talk with anyone interested in pref equity or wanting to know a bit more about our programs.
Awesome. Thanks for coming on the show.
All right. Thanks, Rob.